Hi, everyone. Thanks for joining us today. I'm Marche, the webinar director at Advice Chaser. Before we introduce our guest and get started, I do need to do a bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars, such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. Well, we are thrilled to bring you today's educational presentation. Attendees are muted, but we do encourage you to ask questions using the chat box. The presenter will answer those queries during or after the webinar today as appropriate. If you ask a question in the chat box, go ahead and leave your phone number as well. If we can't get to your question during the event, we'll make sure someone reaches out to you afterwards. We want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. I'd like to introduce you to our presenter today. J.R. Gururi is a certified financial planning practitioner that utilizes a unique approach and methodology called financial life planning. Life planning connects the dots between our financial realities and the lives we long to live. This method is based on the premise that advisors should first discover a client's most essential goals in life before formulating a financial plan, so a client's finances fully support those goals. As a lifelong learner, musician, and athlete, J.R. holds a black belt in Brazilian Jiu-Jitsu, trains Muay Thai, and has been playing the guitar for over 30 years. He actively performs and writes music in his band. And J.R., now that we know a little more about you, I'm going to go ahead and turn over the time to you.
Thank you. I love the intro picture was a person on a plank on a cliff looking down. And there is definitely a good analogy there as to what happens when we invest our dollars. Yes, at some point in time, you are going to fall. And the question is, how good of a harness and safety harness do you have that's going to, and how far down you're going to go is what we're going to talk about today. So I think that was one of the most appropriate pictures I've seen in a long time.
Oh, great. Well, I'll tell my team, thank you for choosing that image.
Okay, so today we're going to discuss risk tolerance and how to create a portfolio for yourself. Now, a lot of we in my business use buzzwords and nobody knows what we're talking about. So a portfolio, let's just start with that. A portfolio is the term we use to sort of get everybody to understand the investments we have. Typically, the investments, the biggest proportion of our investments, not always, is inside of something called a 401k or a 403b or a retirement plan at work. That's where most people store their investments for the long term. It doesn't have to be there. There's all kinds of places you can store money. So the storage of money into these investments is called your portfolio. And your portfolio is made up of let's call it three distinct things. The first one is cash. Yeah, cash, like money in the bank, right? So most people's investments have a portion of their money in just American dollars. The second thing they have is something called bonds. For today's presentation, let's just assume that bonds are the lower risk investment, meaning that they typically don't lose value and are often guaranteeing you a level of growth over time. Okay? Now, it doesn't work out like that in reality. And but generally speaking, we'll call that the safe financial instrument. Doesn't really go down much at all, if any. And it has something called an interest rate attached to it. So the growth rate is the amount of interest you receive. And then finally, the third thing that most people have inside their portfolio is something called stocks. And I think that's a good place to start. Yeah. Okay. And if you have any questions about those three definitions, it's probably good. We're going to have another conversation along the way. Okay. So risk. So when we talk about risk in our investments, there's an element of loss that you have to, and well, even better, I like that word uncertainty, as it's the first word there, and uncertainty. We choose investments because we believe that over a long period of time, the company that we are purchasing, we're purchasing companies when we buy stocks. That's what we're buying. And those companies, we are expecting them to grow. And for some odd reason, for the last 100 years or more, businesses are designed to continue to grow and grow and grow and expand and lower costs and increase revenue and add new products to their product line and add new services to their product line, create technologies that make their stuff better. And as long as we keep doing that, for some reason, the values of these things tend to grow over time. That is our system. Now, the bonds are a little bit different. The bonds are the thing that essentially what you're doing is you're lending your money to these institutions like the government or big companies, and they'll pay you interest on those lent dollars, and then they'll give you those dollars back when the agreement's over. Okay, so risk is two things. With the bonds, it's does this financial institution, will they pay me back? And if they go broke, then they can't pay me back. That's risk, and I lose money in that situation. Doesn't typically happen all that often, but it can happen. With stocks, it's a little bit different. At certain points in time, certain companies, the expectation of that institution is not going to make more money in the future. They're actually going to start losing money, right? Less revenue. And then in that situation, the value of the company will be diminished. And then you either decide to hold on because you believe the long-term strategy of that company is good, or you get out, you jump ship, you sell and you get out, and you could sell for either a gain or a loss relative to the day in which you bought it. Okay. So when we compile these investments, we have a say in our overall investment accounts, all of them all put together, how high they go and how low they go. We can determine that before we even show up to the conversation, which is really important. People don't even know this. They just go, oh, I'll just accept whatever happens. You do not have to do that. Okay. And so you can show up to the conversation going, I want to be really aggressive, or I want to be very conservative, or somewhere in the middle. And that's really important. Okay, now how you determine your risk is based on factors. The factors should be what your goals are. If you have big, lofty goals, you're going to need a lot of money. So you either have to save more or invest in more aggressive strategy. Your age matters, right? Because if you are, very young, and you probably said to yourself, I'm not going to touch these dollars until 40 years from now, let it do whatever it needs to do. Some people go, well, I need these dollars right away, so I better not let it be too risky. That matters. So your age matters. Yeah, how much money you make matters, right? If you make a lot of money and you don't need those investable dollars right away, let them do what they need to do. If you don't make a lot of money and you're relying on those dollars, we have to make a different decision on it. And then, of course, your experience, right? Is your experience, I do this myself? Is your experience, I hand it off to a professional? Is it a blend of both? That will also factor into your risk tolerance, what we call risk tolerance, what you're able to tolerate, right? How much money am I able to tolerate being down on something? Right? That's important. Okay, next slide. Okay. So what really smart people, smarter than me, have done is they've created technology to take complicated aspects of people's behaviors and put it into a game by asking people questions. And the game will, like I said, take very complicated human behavior and simplify it in a way that you can go, this is what I want to do with my investments. And I'm going to demonstrate that for you today. What the questions you see here on the screen, I'm going to go into further detail. I don't have to go through each one, but they're kind of interesting, right? Like, what would you do if you knew you were going to lose money in 6 months? How would you behave? Okay, would you get in? Would you get out? Would you stay with it? That's important questions. Okay, next slide. Okay, so the game, like any other game, will have a score. We are going to demonstrate in a few minutes what that looks like, but what we're going to use is a scoring methodology for people to understand how to put together their own portfolios. And with a scoring system, what you want to do is match your score with the scores of investments. And I'll demonstrate what that means in a moment. Okay, so this is a moment where I'm going to share my screen. Okay, so I'm about to share my screen and show people a financial, it's like a financial technological software program. I'm not saying that anyone has to buy this. I'm not saying anyone has to use this. I found it very effective to convey really complicated ideas in a very, very simple way. Okay.
All right, we can see it just fine. Yep.
Beautiful. Okay, so Advice, first name Advice, last name Chaser is the client we're working with right now. Okay, so let's talk about this concept called using games, questions, and technology to come up with a strategy. So I am going to use a questionnaire to explain these complicated concepts. All right, so on the screen, in blue, and in the middle underneath the blue is a street. This software is comparing investing to driving. Okay, so determining how fast you're comfortable traveling on your investment journey is the first step for me to develop a financial strategy that's right for you. People, everyone has a risk number. Let's figure out what your risk number is. Okay, so I'm going off the off script here. Investing
Okay.
is like driving. So this is where we get to have jokes. Okay. So everyone can see where it says risk and the numbers moving. That looks like a speed limit sign. So we all know that driving can go from 0 miles an hour to 99 miles an hour. If I score a 99 on this in this game, that's driving really fast. When I'm driving really fast, doing 99 miles an hour, really hard to make a turn when things are going wrong, right? I kind of like to say, if you score 99 in this, you're the kind of person that likes to go to Vegas, go to the tables, bet on black, and hope for the best. If you score a 1 on this program, you're the kind of person that if you lost 1 penny investing $1, you would have a heart attack, and then anything in between. That's not an official statement stated by this financial tech company. I just made that up to make people laugh a little bit. That's not official, but you get the point. All right. So let's start out with your goals. What are your primary financial goals? I would say most people have retirement. Would that be good?
Mm-hmm.
And I'm going to ask Marche these questions, everybody.
Yeah.
So she doesn't know what's coming.
All right, I'm here for it. Let's do it.
Okay, so you got retirement. Anything else?
Wealth accumulation.
Yep.
Income.
I love it. All right. Let's talk about your financial status. Anything interest in terms of employment, inheritance, major expenses. We could skip this one right for now.
Yeah,
All right, how much money do you have invested? So, like, obviously, I'm not going to ask Marche exactly how much money she has, but what I want to do is use simple numbers. So, for some people, this might be a big number. It doesn't matter. I'm just using it. $1 million assumed to be the amount of money in my account that's invested, right? The reason why I'm using this number is when we use percentages and we multiply things by $1 million, it's really easy to understand, and mess around with things, okay? All right, now her birthday, I'm just going to use the year that I was born for the sake of, and we'll assume some retirement age. Okay?
It's pretty close.
Good. And then finally, we are now in the area of questions.
All right,
So
I'm
how do
ready.
you feel about the markets?
So is this
A or B?
currently or in general, just about the market? Positive,
say
I would.
Currently, yeah.
Currently,
I'm going on the
positive.
other way. All right.
Let's say positive.
How do you feel about your financial future?
Ooh, that's good. Anxious.
Anxious. Now, normally what I would do is I would go into a further conversation. Like, what do you mean anxious, right? Like, let's talk about this. I need to discover what's really going on, right? So these are questions to get people to talk about how they feel about the investment world. But for the sake of time, we're going to skip that. Okay, risk and reward go hand in hand. It's important for me to know the amount of risk you're comfortable taking, but the amount of money you are looking to gain over time. Okay, this is important. I can't transport you to 10 years from now. Human beings can't imagine themselves, like, we can't imagine ourselves an hour from now, let alone 10 years from now, right? So we have to get the number, the amount of time from now where everyone can kind of like see themselves, right? So it says, I just want you to imagine 6 months from now. It's June, July, right? Right at the end of June, middle of June, July, summertime. And you invested your dollars, the $1 million into the market, okay? And I am telling you right now, you're going to open up that statement because you're not going to look at your investments for 6 months. You promised me you won't look. And then you open it up and you go, it's down. And in the world of investments, when we're down money, the color is always red. I don't know why. Maybe is it, I don't know, blood red? I don't
bleeding.
know.
You're bleeding.
We're bleeding. Thank you. Okay. So the red number, we'll talk about the green number in a second, but the red number represents how much money I've lost June 18th, 2023. I need to know where you buckle. Your heart drops into your belly. You're nervous. Maybe you start to perspire a little bit, something along those lines. And there's no right or wrong answers. You can see my little slider here, moving to the right and to the left.
Okay, so
$1 million, 6 months. You just know, tell me the number.
After 6 months, I mean, 6 months isn't very long in a time horizon of retirement because I'm thinking about retirement. So I would say maybe really close to the end there.
Anything you want, just pick, tell me.
Yeah, right about there. Right about there is good.
What's there, 170?
Sure.
So you're going to wake up 170, you're negative 170 in the account from $1 million. You're like, I got to call JR.
$1 million is not, that's not a lot of money, but maybe push it over a little bit more. I'm
Over
more
left or right?
To the right.
All right, we'll get you to 180.
Yeah, that's good.
All right, so that's it. If it was $1 over $181,000, you're calling me up going, JR, we got a problem. We got to talk about like what we need to adjust, correct?
Okay. Yeah.
Fair enough. And everybody's different. So don't, and there's no
Yeah,
judgment.
we're playing with fake money here. So
Playing with fake money. Well, that's the thing. That's why it's so hard to do this.
Yeah.
Right? It's like, even when it's real money, it's hard to transport yourself 6 months from now. Okay. So 181 was the number. And then instantaneously tomorrow, you're down $162,000 tomorrow. What do? Stay invested or get
stay
out?
invested.
Okay. This is a dilemma test. I'm putting you in a dilemma. Okay. Would you sacrifice some of the potential upside for the safety of a certain outcome? So you can only choose A or choose B. A is this situation. 6 months from now, I open up the account and I'm either down $180,000 or I'm up $268,000. Got it? Or anything in between. That's the potential outcome. Or do you say, JR, put me into an investment where I'm guaranteed $35,000 in 6 months?
Yeah, I would choose A.
Hey, all right. So that, by the way, that's a positive 26% gain versus a negative 18% gain, as you can see on the screen. Okay, A it is. All right. Second question, same situation, negative 180, positive 268. However, they're offering you 70 grand to guarantee for 6 months.
Still choose A.
A it is.
And this is a this is the 6-month scenario, correct? Okay.
Okay. They sweeten the deal. Now you can get same A again or $88,000.
Yeah, A.
A it is. I think we got the 99 here on this table. We got the Vegas person here.
I was just thinking. Yeah. No, just
100 grand guaranteed.
A one more time because
A one more
it's
time.
only 6 months. And so I just think in the back of my mind, I'm not going to retire for years and years and years.
Okay.
All right. I would do B at this point.
All right, now she's a beer. 150,000 seems like a lot of money to you. Okay, so based on your questions, you're coming in at 89, high score. All right. So for the sake of time, I'm just going to say, yes, that feels like you. You're comfortable risking $240,000 over the next 6 months to gain 350. Fair? You're willing to lose 24% in order to gain 35 in the course of 6 months. Got it?
All right.
All right. Okay, so now to come back over here. Let's talk about the results. So you have a risk score of 89. So people have risk scores. Investments have risk scores. Okay, so let me show you what I mean. So let's assume, so right here we're in this risk number section. That's your risk number. I'm going to say, let's talk about what you currently have as a portfolio. Now, I've never seen your portfolio. Everybody's got a different one, but let's create one. So for the sake of time, there's all these different companies out there. There's BlackRock, there's American funds people have heard of, there's Vanguard. So let's do something like this. Let's assume that I sat down with you and I discovered that you had a 55 risk score. I'm sorry, your portfolio had a 55 risk score.
Okay.
Okay, let's do $1 million. Okay. So what's this Voyager 55? The program just created this thing called the Voyager 55. And what they put in here was real investments. So you can see here, 26% of your money is in this fixed income thing called First Trust. 25% of your money is in a large cap US equity select exchange traded fund, and so on and so forth. Okay. Any questions on that? You're invested. And that's what you handed this over to me. Somebody created this for you. It was set up at your 401k company. I don't know. This is what you have.
All right. So these are just all of the securities that I'm invested in.
Correct. All right.
And so that fixed one at the top, is that like bonds we were talking about?
Correct. And I believe I can click on analytics. Yes. No, I can't go into each one.
Okay.
Okay.
But it looks like most of them are like ETFs.
They're all ETFs. Now, if you wanted to add one,
and then,
right?
Mm-hmm.
So if I want it, for the sake of time, let's just say that you're in love with electric cars. People seem to be in love with electric cars. So you said, I'm going to buy Tesla. Do you see what the risk score of Tesla is?
Yeah.
99. high risk, right? So if I add this into your account and I put a lot of money into it, it's going to increase this score. Does that make sense?
Mm-hmm.
Likewise, if I put a bunch of cash into this, what's the risk score of cash? Could you imagine?
I mean, it's lower. It was it like 1, 0, something
One.
like
Yeah,
that.
it's one. It's a one.
Mhm.
So if I add a lot of cash to my portfolio, this number will go down.
Mhm.
Fair enough? Okay.
Yeah.
And this is very common that I will sit down with somebody, do this presentation, and then someone will be, okay, it doesn't matter what the numbers are. This
Mhm.
is an 89, this is a 56. It's not hard to discover that these numbers are not similar. They're far away from each other. Now I have a conversation that needs to be had. So your investment appetite states that you're willing to accept a higher degree of loss or risk in order to do what? To get what?
To get higher returns.
Higher returns, okay?
Mhm.
But if you're in a portfolio where your risk appetite is much less than what your actual one is, don't you see
Mhm.
that there's a reason for conversation?
Absolutely.
All right.
Because in the back of my mind, I think, well, I'm not risking enough to create a retirement income that is sufficient for when I'm retire.
Correct. Okay, so I'm going to actually make this come alive so that you see where this is coming from.
Okay. All right.
And the way in which I make this come alive is through a process called a stress test. And that was the last slide we saw on the thing. We don't have to switch back and forth because I can easily go through it. So a stress test. So when I go to the stress test tab right here, what it's going to do is put the portfolio that you have under stress. Stress goes in two directions. Stress can, believe it, there's good stress in this world and there's bad stress. So good stress means what happens to your account if the market goes up. That's good stress. Bad stress is what happens to your account when the market goes down. We want to know these things. Okay, so I click on this little link here. And what the program says is this. In the year 2013, the United States stock market gained 32%. Now, for people that don't understand this, 32% in 1 year is awesome. That's really good. That's not normal. Okay, it's out of character. Okay, so if I have a $1 million portfolio, okay. Well, let's just, I'm going to take a step back.
Okay.
The United States stock market, we use a barometer called the S&P 500. For those that don't understand, it's the 500 biggest companies in our society. For an overly simplistic definition, it's the 500 biggest companies. The 500 biggest companies, if you were to invest in them exactly the way the S&P 500 is, that is a risk of 76. Okay, so if I identically invested in the S&P 500 in 2013, how much money would I have gained on a $1 million portfolio? Can you answer? Just so that people understand.
Okay, so it's 321,000.
Right, or 32%. If I invested exactly like the S&P 500.
Okay.
But you show up to me and say, JR, this is my portfolio. Well, I'm going to tell you, if you create the same portfolio that you have, leave the portfolio the way it is, and 2013 repeats itself in the future, how much money are you going to make in that year? $194,000, right? Okay, therein lies a really interesting concept where you have to, if you're seeking higher returns and the market's going to give you 320, you're only going to get 194. Are you sad or are you fine with that? And if you're sad, then I'm going to go, well, we need to adjust your portfolio. Okay. Now, you're an 89, right? What would an 89 do? So let's come back here. So let's get, let's do the Russell. Okay. So if you were the 89 that you are, you would have gotten 300 around. Now, man, this is, these are averages. I
Right.
got around $383,000. So more than the S&P 500 had you invested more like the way you are. Okay. So not only are so there's a lot of money being given away here. Make sense? Okay. So that's the good stuff. Let's look at the bad stuff. In the year 2008, the United States stock market lost 40% of its value. Okay. So someone who invests like the entire S&P 500 would have lost 37% or $370,000. Okay. Your current portfolio would have only lost 200. So you kept $170,000 in your pocket. Now, if I transfer you to the 89 score portfolio, you went down almost $450,000 on a million, close to almost half. All right. What happened in the financial crisis? 2007, 2009 stock market lost 50% of its value. Here's the numbers there. Down $533,000 on $1 million portfolio. Yours would have lost $300,000, and this aggressive portfolio would have lost $647,000. I mean, this is what happened. Okay, so I hope you're getting this, and this is the takeaway. The takeaway is that, isn't it kind of a powerful position to be in, to know what's going to happen if certain things repeat themselves? So if I know ahead of time that I'm only able to handle a $500,000 loss, if the worst of the worst ever happened again, which the worst of the worst was, as you see here, 2007 and 2009, and I can only handle a $500,000 loss, that's all I can stomach, then I know I should be in a 76 portfolio or something like that. If I'm like, who cares? It came back, right? 2007, 2000 came back, and we're up way more than we ever been. Let it ride. Well, then you should be in an 89 portfolio. And if you're very risk averse and just seeing red numbers just makes you ill, then you should be in a much lower allocated portfolio. So what we do is we start creating portfolios from scratch. You could do this yourself. You don't need me. You use professionals. There's all kinds of money managers out there. There's so much information for you to help put these together and figure out, okay, how do I construct this one step at a time so that I'm in a portfolio that just makes sense to me? Because, and this is going to make everybody's, getting wealthy by investing is boring. And it's supposed to be boring. It's not meant to be exciting. So set it and let the strategy unfold. Now, there are reasons why we make adjustments over time, but typically the reasons why we make adjustments is because life came at us with a different thing, right? We get married, we have children, we change careers, we move to different areas of the country, we live abroad. Whatever the situation is, yeah, it makes sense to revisit this. Some people want me to do their risk tolerance every year. Some people don't talk to me for 5 to 7 years before we look at this again. That's the overall takeaway from this. So that's the demonstration. Is there any thing on the slides that we need to just review?
No, we don't have to go back to the slides just yet, but I'm going to go ahead and ask a couple questions that we've gotten. So what if people are going through this kind of scenario and they say, oh, that really is too much, can we go back and adjust my risk score?
Yes. Oh, yeah. So that's pretty common, right? So we go back to risk number. And I've had people go through the whole thing. They're all confident. And see, it says update risk number.
Yeah, let's
literally just, let's make that a little more like that. Yeah, and then I could put notes here and all that kind of stuff.
All right, so that's a question here. Here's another question. Is this tool available to the consumer?
It is available to anyone if you want to pay the fee. It is not cheap by for most people, because it's really designed for financial professionals to pay a monthly fee and provide it to their clients. I'm sure there's millions of financial professionals that use this. I am one, so if you love it, obviously, it's part of like my package that people get certain software programs and portals and things. So
Yeah, and a lot of financial advisors use this or something else that
yeah, and
calculates risk. It's one of the tools out there.
yeah, and I think like almost all of them now offer some kind of similar structure. It's not, I really don't feel like it's that like so patented now, that concept of risk score that, it's only one company.
Yeah.
I've seen it in a lot of different companies now.
All right, here's another question. What determines an investment's risk number?
It's past like quantitative, like they take all kinds of information from their stock price performance, their standard deviation from price they use. I mean, it's like complicated statistics. That's essentially what they're doing, right? And looking at it and like, how much does this thing move in any given time and under any given circumstance?
Okay.
And there's a lot of different things that have risk numbers. So you can put stocks, bonds, cash, gold, precious metals, life insurance, annuities, all these things, at least in this program, have some kind of risk number associated with it. And that gets really interesting too. Just like, so people often compartmentalize their investments, right? So what is the risk score of my stock investment portfolio, right? And so they do their planning around that. We can get really interesting, right? So if I take my stocks and then I combine my life insurance policy and I combine my bank account and I combine my, my real estate, what is the risk score then, right? And so what I like about that concept is, let's just say I am an 89, but I couldn't stomach the, the $500,000, $600,000 loss. Well, you didn't really lose $500,000, $600,000 as a human being. You only lost that in that one thing. So it allows you to be more aggressive in that one thing while still feeling safe with dollars in different places. Does that make sense?
Yeah, that does make sense. So maybe someone's more aggressive in a certain area, but other areas like, their life insurance policy and their real estate investments, those are different. Yeah, those are different. Yeah, that's very interesting. So it is, I can see a mix there. Another question here. What role does inflation play in risk tolerance?
So inflation, what I would do in that conversation is I would switch programs. Okay. And then, so now what I'm doing is I'm looking at financial planning as a whole. And the financial planning software as we utilize says, okay, here's my risk number. Here's how much I'm saving every year. Okay. Am I on track to achieving my goals? And if the answer is yes, okay, then I go, what was the assumption of the inflationary rate? And then I go, okay, well, what is the assumption if the inflationary rate is, instead of being 2%, 2.5% on average, is now 3.5%? Do I still achieve my goals? The answer is no. That means you have to save more money or change the investment structure, right? The more aggressive you are, the higher probability you're going to stay ahead of the inflationary rates. So that was that's a convoluted answer to the question, but I mean, like, that's the way you do it. I mean, there's no other way.
All right, and then one other question here. A lot of people have life cycle investment accounts for their retirement.
Yep.
Can you talk a little bit about how those play into maybe like a risk tolerance and what life cycle means there?
Sure. By the way, the program that I just had, it has a button for inflation. So you can change that. And it does exactly what I just said it does. I just don't use it on here. I use it in a different program.
Okay.
So the question is, what is the relationship with life cycle and this? So life cycle investment strategies have a risk score today, right? But if anybody understands a life cycle investment, what happens is that the investment strategy changes as time moves forward. So every year, the programs adjust what the life cycle investment strategies are. So like these programs are updating this stuff in real time all the time, right? If they change the structure of their investment strategy, then they adjust the risk score. Does that like answer the question?
Yeah. Can you explain a little bit about what a life cycle retirement
Sure.
kind of account is and why it does adjust?
Okay, so they're trying to like life cycle investment strategies are just trying to be like the one-stop shop for a retirement person planning for retirement, right? And such that you don't have to think about anything. Just rely on us and we'll do the investment strategy for you. And so it says something like this. If I'm, let's just say I'm 40 years old, right? And I know I'm retiring at 70 years old. So I do, if today is the year 2023, and I'm retiring in 30 years, 2023 plus 30 years equals 2053. So you go out into the marketplace and go, I want a 2053 life cycle investment strategy. And what they'll do is essentially, and you just say, well, I'm an aggressive investor, I'm a medium risk tolerance aggressor, or I'm super conservative. Let's just say I'm going to go with aggressive because I'm young. So I'm aggressive. So 90% of the dollars invested in a life cycle that's 30 years long, all right, is probably going to be invested in the stocks, stocks, international stocks, growth stocks. And if you don't understand these terms, we'll have to talk about that at a later date. But like, and that sort of mid cap stocks, small cap stocks, 90% of the money's there. The other 10% will be in like what we call bonds, like not like the more conservative. So most of my money is in what I would call aggressive investments, right? And then what happens is as I get closer and closer to retirement, every year they're adjusting that. So instead of being 90%, let's just say by the time I'm like 10 years away from retirement. So I said 2053. So in 2043, it's probably like 60% of the money that you have invested is in stocks and small caps and growth stocks and in international stocks. I'm just making up that number. You can't quote me on that, but like that's kind of so it's adjusting every year so that when you're at retirement, right? So let's think of it as retirement. So here I am at retirement now, and I started it with zero. Now I have $1 million. And in the first year of retirement, what happens? Stock market drops like it did in 2022, excuse me. So stock market, some lost like 18%, the NASDAQ lost 30%. And then, and so that account dropped, right? But if it was automatically adjusted to more bonds by the time I'm 70 years old in 2053, well, the down move in the market wasn't as dramatic to my overall portfolio at that time. And it was all automated for me. I didn't have to do anything. I have to think about it. I didn't have to call anyone. It's just done for me. There's pros and cons to that, right? The pros to that is, it's like, you don't have to think about it. And the more people don't have to think about investing, usually the better, right? Because they're going to make mistakes. However, the flip side is that if you're like a person who really likes to be in control and you're a person that likes to make their own decisions and you've discovered that it's a very opportunistic time to be aggressive, you're missing out on all those dollars. So pros and cons. It's so interesting. Our business it's just about pros and cons. It's not right, wrong, black, white. It's none of that. It's just like everything has an outcome and you have to understand what the outcome is and then make your decision accordingly, knowing what the outcome is. That's why I love the concept of being able to create a risk score and setting up my risks now, because when I show up to the event of, let's say, losing money, I've already been prepared. I know how to deal with it. I stay my course. I stick to my strategy. If it's a surprise to you and you see you've lost money by surprise, your behaviors and your decision-making is it's typically not going to serve you. You're going to make mistakes. And when we make mistakes in the world of money, we tend to lose them permanently. So that's why, I really like these kinds of concepts and setting up before we get there.
Well, thank you so much. It's a good thought to end on today. And to the people who have maybe put in a question or had a question that didn't get answered, go ahead and put that question in the chat. While I finish out today, I'm happy to save those and get those addressed after the webinar. Well, I want to thank JR for being here and for the organizations that have worked with us to bring you this webinar today. Thank you to our attendees for attending. Look for an email soon with a link to the replay of this event, and you're welcome to share that replay with your friends and family. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Once again, from Advice Chaser, thank you so much for coming, and we'll see you at another webinar soon. Goodbye, everyone.